Hello everyone. Welcome to this lecture on IAS 41 where we are going to explore the main characteristics of biological assets, dive into the accounting for bearer plants, and then we will outline the rules for recognition of biological assets, their measurement with a simple illustration, and the presentation of biological assets in the financial statements. In the last lecture, we have already learned that biological assets refer to living animals or plants, and the main characteristics of this asset is their ability to undergo biological transformation, a natural process of growth, reproduction, or degeneration that occur with the help of some natural resources like sunlight, water, air, and soil. Let me give you an example. Think about a little chick. It grows into a hen. Or consider an apple tree. It grows taller, starts flowering, and eventually bears fruit. This transformation process is what sets biological asset apart from other asset, and it's absolutely central to the agriculture activities. Without it, there is no agriculture production system. Now, when we talk about biological transformation, it can happen in two main ways. The first type is asset changes. This includes growth, like when a calf grows into a cow, and degeneration, like when an old fruit tree starts producing lesser fruits before eventually dying. And the second type is asset creation. This can happen in two forms. Number one is production, which gives us non-living product like wheat, fruits, and milk. And the second is procreation, which gives us living product or animal. For example, a cow giving birth to a calf. Now here is the key takeaway. You need to remember that this biological transformation is what drives the economic benefits in agriculture. Because without biological transformation, there is no agriculture production system. Without it, we won't have crops, fruits, or livestock to sell. And based on what role a biological asset plays in the agriculture system, they are categorized into two categories. The first category is consumable, and these assets, either plants or animals, are themselves harvested. For example, carrots, wheat, and fish are considered consumable because they are grown and sold directly. And the second category is bearer, and these assets bear produce for harvest. These assets are not consumed themselves but are used to produce agriculture goods over multiple periods. A great example would be coconut trees, apple trees, or grapevines. They stay in the ground for years, producing fruits season after season. Now, let's first explain the accounting for bearer plants. Careful, you can also have bearer animals, but we are focusing on bearer plants now, not bearer animals. Bearer plants are those that are used solely to grow produce over several periods. Think of coconut trees, apple orchards, or grapevines. These plants are not grown to be harvested themselves. You don't cut down the apple tree to sell. You pick the apples and keep the tree. Once these plants are no longer productive, they are scrapped or replaced. Now, how do we measure bearer plants? Well, this has been a debate for years. Initially, Bearer plants were treated like biological assets under IAS 41 and measured at fair value. But this caused a lot of problems. First, fair value model did not make sense for bearer plants. The reason is that bearer plants are similar to machines in a factory. They help produce goods over time rather than being sold themselves. Second, it was nearly impossible to determine fair values for the bearer plants in many cases. Imagine trying to figure out the market value of a mango tree that is expected to produce mangoes for another 20 years. It's not easy. So in 2014, IASB decided to exclude bearer plants from IAS 41 and brings them under IAS 16, property, plant and equipment. It means that until bearer plants are mature to produce, they are measured at cost, just like a machine being built or installed in a factory. And once they mature and start producing, you need to begin charging depreciation and recognizing any impairment losses if applicable. But, and this is important, don't confuse the bearer plants with their agriculture produce. For example, let's say you have a coconut tree. The tree itself is measured under IAS 16. But once you harvest the coconuts, they are treated under IAS 41 at the point of harvest. And after that, the coconuts are transferred to IAS 2 inventories and are measured like any other inventory item. So to summarize, bearer plants are treated like property, plant and equipment under IAS 16 and their produce is accounted for under IAS 41 at the point of harvest and then under IAS 2 inventories afterward. Alright, let's now talk about the recognition of biological asset. That is, when we should recognize them in the financial statement. IAS 41 outlines 3 criteria for recognizing biological asset, and honestly, they are pretty similar to the recognition criteria for most of the other assets. The first criteria is control. The entity must control the asset as a result of past event. What does that mean? Well, you need some kind of proof that you actually own or control the asset, like a legal title, purchase agreement, or even branding if you are talking about livestock with identification mark. For example, if you own a herd of cattle, the ownership paper or branding marks prove that you have control over these assets. The second criteria is that it must be probable that future economic benefits associated with the asset will flow to the entity. And this is where the biological asset stands out. They inherently grow or produce outputs, making it relatively easy to predict the economic benefits. For instance, a herd of cow will produce milk, calves, or meat, and an orchard of apple trees will bear apple fruit. These physical attributes make biological assets naturally capable of generating economic benefits. And the third criteria is that fair value or cost of the asset can be reliably measured. This one is crucial because measurement forms the basis of accounting for biological assets. Now that we know when to recognize biological assets, let's talk about how to measure them. The basic measurement rule in IAS 41 is to measure biological asset at fair value less cost to sell. And this needs to be done at each reporting date. But what exactly is fair value less cost to sell? Fair value is essentially the market price you would get for the asset minus any cost involved in getting the asset ready for sale, like transport fees, transfer taxes, brokerage commissions, etc. The standard says that the primary indicator of fair value is the net market value. And to determine this, IAS 41 asks you to look at IFRS 13, Fair Value Measurement Standard. You should be looking at the principal market as defined by IFRS 13. This is when there is more than one market where you can sell the asset and the prices are different in each market. In such case, you need to look at the principal market, the one with the greatest volume or the highest level of activity. For example, if you are selling wheat and market A handles 80% of the wheat trade, while market B handles only 20%, obviously you will use the price in market A as your reference point. But what if for some reason the fair value is not available because the market prices or market values are not available? In this scenario, IAS 41 allows you to measure the biological asset at cost, adjusted for depreciation and impairment losses, if any. But this applies only to non-current biological assets, because current biological assets like crops ready for harvest would be gone from the financial statement within a year. Also, keep in mind that measuring non-current biological asset at cost is allowed only at initial recognition. Once the fair value becomes available later, you have to switch to measuring at fair value less cost to sell. Now, let's say you have measured the biological asset at the beginning of the year and then remeasured it at the end of the year. The difference between the carrying amount at the end of the year and the carrying amount at the beginning of the year is treated as income or expense in the profit and loss statement. But here is something important. This total change can actually be split into two parts. The first part relates to the change in fair value. For example, if market price for cattle increases, the fair value of your herd might go up even though the cattle themselves have not grown much. And the second part relates to physical changes in the biological asset. For instance, if your cattle grew larger and gained weight, or if new calf is born, this physical growth adds value to the biological asset. You are required to disclose both components separately in your financial statement, but only if it is useful to the readers. For example, if you are dealing with a short-term biological asset like broiler chickens that are raised and sold within 6 weeks, there is no need to split the changes into two components. In such cases, a single figure is sufficient because detailed breakdowns would not add much value. So to summarize, biological assets are measured at fair value less cost to sell unless fair value cannot be determined, in which case cost is used temporarily. Changes in the carrying amount are recognized as income or expenses, and these changes can be broken down into changes in fair value and the physical change. But detailed disclosures depend on whether the information is useful for the readers or not. Alright, let's now work through a simple example to see how we split the changes in the carrying amount into two parts. One related to fair value changes and the other related to physical changes. Imagine this scenario. At the start of the year, on 1st January 2001, a farmer has 100 calves and the fair value less cost to sell for each calf is $40. By the end of the year, 31st December 2001, the farmer has 95 cows and the fair value less cost to sell for each cow is $70. Keep in mind that the calves have grown into cows during the year and 5 cows are no longer in the herd. Maybe they were sold or lost during the year. So, how should a farmer measure this herd? The first step is to calculate the carrying amount. At 1st January, the carrying amount would be 100 calves multiplied with the unit fair value less cost to sell of $40. So that is $4,000. And at 31st December, the carrying amount is 95 cows multiplied with the unit fair value less cost to sell of cow at year end, which is $70. So it is $6,650. So the difference of $2,650, that is $6,650 less $4,000, is the total change in the carrying amount, and it will be recognized as income in the profit and loss. But we need to split this amount into two parts. First, let's see how much of this change is due to changes in fair values, not growth. For this, we have to look at the 95 cows at the end of the year, but value them using the beginning of the year price, which was $60 for a cow in our scenario. So 95 cows multiplied by $60 is equal to $5,700. Then compare this with the year-end values using the year-end price, which is $6,650. So the difference of $950 is due to changes in fair value. So you are effectively comparing the fair value less cost to sell of the same asset, cow in this case, at the end and at the beginning of the period. Now, the remaining difference of $1,700, that is total change of $2,650 less fair value change of $950, is the difference attributable to physical change or to the fact that calves grew and became cows. Both changes, physical growth and price increase, are recorded as income in the profit and loss statement. However, IAS 41 requires you to disclose them separately so that users of the financial statement can clearly understand what portion of gain is derived by growth and what portion is derived by market condition. Now that we have covered the measurement, let's move on to the presentation. That is, how do we actually show the biological assets in the financial statement? Biological assets must be presented as a separate class of asset on the statement of financial position. This is because they are fundamentally different from other type of assets like property, plant and equipment, investment property or financial asset. Then a lot of disclosures are required, and one of the most important one is to further subclassification of biological asset, either on the face of the statement or in the notes to the financial statement. Biological asset can be grouped by the type of animal or plants like cows, sheep, apple trees or grapevine, or these can be grouped on the basis of their purpose, like whether they are consumable assets like livestock raised for slaughter or bearer assets like dairy cows used to produce milk. Biological assets can also be grouped on the basis of their maturity, like whether they are immature assets like calves or mature assets like fully grown cows. This kind of subclassification gives reader of the financial statement a clear picture of the entity's agriculture operation and the role these assets play in generating economic benefits. IAS 41 also places a heavy emphasis on disclosures, and rightly so, because agriculture involves complex judgments and estimates. Entities need to disclose the nature and the type of biological assets they hold, whether the assets are measured at fair value or cost, or any methods or assumptions used to determine those values. Gains and losses arising from the change in fair value and physical change, just like the example we worked through earlier. Risk management strategies for dealing with uncertainties involved in agriculture, like market fluctuation or disease outbreaks. So my friend, we have covered quite a lot in this lecture. We looked at how to recognize biological assets, how to measure them at fair value less cost to sell, and how to split changes in carrying amount into fair value adjustments and the physical changes. We also talked about the presentation and disclosure to ensure that financial statements tell the full story of the agriculture operation. This is the end of this video, and I will see you in the next one. Thank you.